Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Cyclical Stocks, Insights for Savvy Investors. Ever wonder why some stocks seem to move in sync with the economy's ups and downs? Welcome to the world of cyclical stocks. These investments ride the waves of economic cycles, booming in good times and contracting when things get tough. Think of industries like travel, automotive, or luxury goods. All thrive when consumers feel confident enough to spend. But what makes cyclical stocks significant for investors? Simply put, they offer potential high rewards if you time the market right. Armed with the right knowledge, you can ride these economic waves to your advantage, turning market fluctuations into profitable opportunities. Let's dive into the power and potential of investing in cyclical stocks. What are cyclical stocks? Ever felt the excitement as the economy expands or the worry when it contracts? Cyclical stocks thrive on this roller coaster ride. They move with the economy's heartbeat, echoing consumer confidence and spending habits. Let's explore exactly what cyclical stocks are and what sets them apart. Definition of cyclical stocks. Cyclical stocks are shares of companies whose performance and valuation are deeply connected to the economic cycle. They're like those friends who are bursting with energy at a party when the economy is strong, but prefer to stay in when times get rough, during economic downturns. Businesses in sectors like automobiles, airlines, and luxury goods tend to see their stocks flourish during economic highs and contract when the market slows. These stocks contrast with defensive stocks, which remain stable regardless of the economy's mood swings. Key characteristics. Understanding the characteristics of cyclical stocks can help you decide whether they're right for your portfolio. Here are some traits that stand out. Economic sensitivity. Cyclical stocks are highly sensitive to changes in the economy. When GDP grows, these stocks typically see increased demand and higher profits. Conversely, during recessions, demand and earnings can decline sharply. Industry dependence. Industries tied to consumer discretionary spending often have cyclical stocks. These sectors include travel, hotels, cars, and even fashion. When consumers have more disposable income, they're more likely to spend on these non-essential items. Volatile performance. Expect these stocks to be more volatile than their defensive counterparts. They can offer significant returns during boom periods but can also present higher risks during slumps. Timing and opportunity. Investors often view cyclical stocks as opportunities for growth by timing the market. Buying these stocks at the bottom of a cycle and selling at the peak can yield substantial returns. However, this strategy requires a keen understanding of economic indicators. Cyclical stocks can be exciting to follow, but they demand attention and insight into economic trends. With these characteristics in mind, they might just become the thrilling investment ride you're looking for. Types of cyclical stocks. Cyclical stocks can be thrilling for investors looking to time the market's highs and lows. They offer a mix of excitement and risk, reacting sharply to economic ebbs and flows. Let's break down the types of cyclical stocks into 3 main categories. Consumer discretionary stocks. Consumer discretionary stocks are like an economic barometer. They gauge the economy's pulse. These stocks represent companies selling non-essential goods and services. Think retailers, restaurants, and hotels. Why do they swing with the economy? Simply put, when people have extra disposable income, they're more likely to splurge on these luxuries. During an economic upswing, consumer confidence climbs, propelling sales and profits for these businesses. Imagine the robustness in the auto industry as more cars roll off the lot during prosperous times. Or consider the surge in retail when shoppers open their wallets wider. That's the beauty of consumer discretionary stocks. Conversely, during downturns, these sectors feel the pinch first as consumers tighten their belts. So, while they offer tantalizing prospects for growth, they come with a need to stay vigilant and informed. Materials and industrials. Materials and industrial stocks are like a well-oiled machine running on the fuel of economic growth. These sectors thrive on the demands of an expanding economy. Materials stocks involve companies dealing with raw goods like metals, chemicals, and forestry products. When construction and manufacturing sectors ramp up, so too does the demand for these foundational materials. Industrials, on the other hand, encompass machinery, transportation, and other heavy industries. Picture the bustling activity in factories and increased shipments on railways during economic booms. These sectors are deeply linked to the production and infrastructure backbone of the economy. But when the economy slows, the demand for raw materials and industrial outputs wanes, hitting these stocks hard. It's a classic case of boom and bust, making timing crucial for investors. Financial stocks. Financial stocks often act like a mirror to the economic environment. These stocks include banks, investment firms, and insurance companies. Ever notice how, in strong economies, there's a lending frenzy? People borrow more, whether it's to buy homes with mortgages or finance new business ventures. This rise in borrowing naturally boosts profits for financial institutions. In contrast, during economic contractions, fear can grip the financial markets. Loan defaults may rise, and consumer confidence in financial products can take a hit. Interest rates also play a pivotal role, influencing profit margins on loans. It's like a tightrope walk for financial stocks, balancing interest rates and borrowing trends. Financial stocks require investors to keep an eye on macroeconomic indicators. Interest rates, employment data, and consumer spending all weave into how these stocks perform. Understanding these movements can unlock opportunities for savvy investors looking to capitalize on economic cycles. How cyclical stocks perform in economic cycles. Cyclical stocks dance to the beat of economic cycles, moving in harmony with the nation's financial health. Understanding this rhythm can help investors make informed decisions on when to jump in and when to hold back. This section looks at how cyclical stocks behave during different economic phases, starting with the boom phase and then transitioning into what happens during a recession. Boom phase. In the boom phase, the economy is on an upswing. Businesses are thriving, consumers are spending, and confidence is high. It's like a party where everyone loosens up and enjoys themselves. This is the stage where cyclical stocks truly shine. During this time, demand surges across industries like automobiles, travel, and luxury goods. Consumers feel wealthy and are more willing to splurge on non-essentials. As a result, companies in these sectors see their sales skyrocket, translating into higher profits. This demand surge fuels stock prices, leading to potential windfalls for investors who are already on board. Moreover, low unemployment rates often accompany economic booms, further boosting consumer purchasing power. The stock market tends to mirror consumer sentiment, and cyclical stocks can soar as investors anticipate continued prosperity. These are indeed the golden days for those holding cyclical stocks, but it's crucial for investors to stay vigilant, as booms can lead to overvaluations. Recession phase. When a recession hits, it's like hitting the brakes on the economic ride. Times become tough, consumer confidence dips, and spending tightens. During this period, cyclical stocks often face downward pressure. Industries that once flourished during the boom now see a stark decline in demand. For instance, the automotive sector may see fewer people buying new cars, and luxury goods may gather dust on shelves. This reduction in spending impacts company revenues, leading to a dip in stock prices. Unemployment rates may rise, adding to consumers' financial anxieties, and the once high-flying stocks can spiral downwards. However, it's not all doom and gloom. Savvy investors keep an eye out for recovery indicators, such as improvements in key economic indicators like GDP growth, consumer confidence, and employment. These signs suggest that a turnaround might be on the horizon. During such times, cyclical stocks can offer significant buying opportunities if investors correctly anticipate an economic upswing. By understanding how cyclical stocks react to these phases, investors can better position themselves to profit from market cycles, making the most out of both highs and lows. Investing in cyclical stocks. Cyclical stocks offer a chance to capitalize on the ebb and flow of the economy. These stocks can reward investors who skillfully navigate their market entry and exit. But how can you tell if a stock is truly cyclical? And what strategies should you employ to maximize gains while minimizing risks? Let's explore these questions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.